Hey guys, welcome to our third and final part of Financial Fundamentals. I hope you've been with me through the series. If you haven't, the other ones are always there for you to go check out. We're going to be covering our last 5 topics for today. So our 11th topic is going to be timing the market versus time in the market. So any financial advisor that you talk to will always say that it's important to have time in the market. And this is just so true. And I'm going to explain the difference between both of them. So time in the market is really staying in there, putting your money in something and forgetting about it. Whether it goes up or down short term, time in the market is putting your money somewhere and, not selling it, just taking a step back and watching it through its small ups and downs. The market will fluctuate, and that is normal, but over any 11-year period, the stock market has only grown up. So if your plan is to leave it in there for a long run, after 30 or 40 years, your money is most definitely, almost always, would have grown. So now timing the market is a total different story. In this, you're waiting for the perfect stock to come at the perfect price in the perfect time. So the market goes through its ups and downs, and you've always heard, buy at the low, sell at the high. It's easier said than done. You might always be trying to see, is this the lowest that'll go? Is it, well, all right, let me buy in. And then you don't know how high it's going to go. The market is completely unpredictable for even anyone, even the best stock advisors out there. So when to sell and all is really hard to pick that perfect time. So sometimes timing the market might make you a ton of money, other times it might not. But really the opportunity that you spend thinking about it and finding that perfect time, you could have put it in there and gained a lot more money in the long run. So it's not normally the smartest thing to do. Another major thing about time in the market is compounding. Your stocks will grow, give you dividends. That'll be used to buy more stocks, and over time, this will just compound and become a large amount. So I'm just going to take a little example that I've made and graphed it up and just show you how important it is to start early and stay in the market for the long run. So right here, I have a situation where I am 20 years old and I invest $100 each month for the next 40 years. So the 20s is definitely the most important years to start investing, and you can earn significantly more money than anybody who started investing in the 30s or 40s. So a little goes a long way, and just by putting in $100 a week starting at 20 for 40 years till you become 60 years old, at a 7% return, you could make a ton of money. Now, think of how much money you could make. How much money? Putting in 100, could you make $1,000? I mean, $10,000, $100,000? The real answer is, yeah, wow, that's a lot of money. $1,038,102. That's how much you can make, but just putting in $100 each week. So from this, what we can see is the most important thing is to start early. As you can see from this pie chart that I created, you only put in $200,000. Where does the other money come from? That's the growth. That's how much you get. So only 20% you put in, and the 80%, the $800,000 of this is growth. So yep, you're welcome. I just made you a millionaire. All right. So to wrap things up, get in the market early, start investing early, stay there for the long run, and don't try to time the market, and you will be good. Our 12th fundamental is dollar cost averaging. So it might seem a little bit intimidating at first, but let me give you an example. So dollar cost averaging is setting aside a fixed amount of money at regular intervals to invest. So let's say I buy milk, $5 worth of milk every week. When the milk price is $5, I will buy myself 1 gallon. Let's say the price of milk goes down for some reason and it's only $2.50. Now I will buy 2 gallons. And then after a couple months, the price goes to $10. I'll only buy myself half a gallon. So you can see, no matter what the price of milk is, I'm putting in the same amount of money each week. So this is basically dollar cost averaging. Even though I've bought a bunch more milk sometimes and a bunch less over this period of time, I'm on average drinking about the same amount, the same 1 gallon or so of milk. So translating this over to stocks, this is basically, whatever the stock price is, whatever it's high, you buy less. Whenever it's low, you buy more. So once you average this out, you'll get a good average amount that you put in every month, which means that you're not missing out on any growth. So add in time in the market, add in compounding, and not missing out on any single month's growth really makes your money and skyrocket and growth go really high. So our 13th topic, we're almost done, is time-based needs. So this one is all about having the right knowledge at the right time. So there's going to be a lot of different events in life that occur, from getting a job to getting a raise to getting kids to retiring. So you need to have the right knowledge so that you can make the best decision for the time. So let's take a couple examples. So let's say you got your first job. Most companies offer what is something called a 401k match. We'll go into this in depth in another video, but this is basically free money. For every dollar you put in, your company puts in a dollar as well. So who likes free money, right? Everybody. So you should put in the match and get that. But a lot of money is left on the table because people are ignorant and don't know about this. So if you didn't know about it at that time, by the time you retire, you might have lost that opportunity. So the next big life event is when you have kids. So when they want to go to college, you need to have a certain amount of money set aside for that. So this is called a 529 plan. So you can contribute to this, right after they're born or whenever. So by the time they go to college, they have money set aside. So this is extremely special because you don't have to pay taxes on any of the growth that happens, right? So if you knew this, you could take advantage of it and save thousands of dollars in taxes. But if you didn't know it, again, it's going to cost you. So all of these are different time-based needs that having the right knowledge at the right time is really going to help you in your financial situation. Our 14th one is financial plan. Now that we've learned all these things, it's time to bring it all together in our financial plan. So this, basically, you have a couple things to consider. Where are you at now? What is your current financial situation? And what are your future goals? Where do you aspire to be in 10, 20 years? And now you need to find out how to get from where you are to where you want to be. So this is basically, where do you put your money in? What is your risk tolerance? Do you put 80% in stocks, 20% in bonds? You put 80% in bonds, 20% in stocks? You want to throw Bitcoin and gold in there, whatever you want. So it's basically, with the money that you have, to get to your goals, where should you put it? So yeah, just even it out, diversify your portfolio. Very important to not put all your eggs in one basket. If that falls, you have nothing to rely and lean back on. So yeah, diversify and try hard and you will get to your goals. Alright guys, we are done. 15th out of 15, and this one is knowing versus doing. Just do it. So, all the stuff now. Listening is great, but putting it in action is what makes the difference. So, all this tons and tons of information, assets versus liabilities, good debt versus bad debt, how to calculate net worth, the discipline of spending and habit and budgeting and all these things. And now is your time to go out and put it into action. So, the market will go up and down. It'll fluctuate all the time, but the first time it goes down, don't panic sell, don't chicken out of there, stay in there for the long run, and you'll be perfectly fine. Make sure to, assess your situation, take calculated risks, create a strategy, create a plan, and stay in there. Start slowly, keep on investing, and grow your wealth in the long run. So thank you guys so much for staying here and watching this video and this entire series. If you enjoyed it, make sure to like and share with others so they can learn it as well. That's been it, guys. I appreciate you guys watching, and I will see you next month with more tech and personal finance videos. Thank you. Bye.